Hey, it's Kevin the Credit Crusher here, and we are coming today to talk to you about some things that I've been encountering over the last few weeks, and that is credit monitoring, particularly credit monitoring alerts and the anxiety that it brings. So today I'm going to talk to you guys about how to get around some of the anxiety that you guys are having with credit scores. All right, and I'm just going to jump right into the conversation today. Some really important content, I believe, so stay tuned. So let me get right into it. I've had quite a few clients, and it's not a problem, but I've had quite a few clients over the past few weeks and months call me frantic about their credit scores because they're using monitoring utilities, credit monitoring utilities, and these credit monitoring utilities are sending them alerts every day. And in some instances, the scores are going down, and these people are worried about why their scores are going down. So let's talk about some things that you are seeing. First things first, there are many credit monitoring utilities out there. There are some that you can pay for, some that come with the credit cards that you use, some that are free. Regardless, they're all good. So I didn't come here to badmouth any credit monitoring utilities. I didn't come to talk about how they don't work. They all work, and they all work really well. So continue to use them. The challenge about them is you've got to be careful that they don't drive you insane, right? I don't want them to drive you to drink or smoke or something worse, right? So let's talk about credit monitoring utilities and what they do and what you should watch out for, and then how to get around some of the anxiety. First things first, what you need to know is each credit monitoring utility may use a different scoring model. Many of you guys have seen some of my previous videos where I talked about the different scoring models, but I'll bring it up again. So there are several scoring models. There are 10 FICO scoring models, FICO 1 through 10, and it's actually 2 through 10. It's because the first one doesn't count. But it's 2 through 10. And those scoring models each use a different metric to give you a score. So if you look at a FICO 8 score versus a FICO 4 score, they're going to be different. Some credit monitoring utilities use FICO 2, FICO 3, FICO 4, FICO 8. So if you compare the two, you're going to get different scores. And as a result, you're going to get different alerts. If you get one credit monitoring utility using FICO 8, it might send you an alert about, let's say, your credit card utilization. If your credit card utilization goes up, it'll send you an alert saying your score goes down by 13 points. Another scoring model might not weigh credit card utilization as heavy. It's going to weigh it, they're going to be weighed in order of importance, but it may not weigh as heavy. So your score may only go down 6 points. How do you know which one to go by? You don't, and I'm going to get into that in just a little while. But just know that each one of the FICO scoring models is going to give you a different score. In addition, there is the Vantage scoring models, and there are there are 5 of those, 4 being used, and one of them's coming out. They're revamping it, and it should be out shortly. It's not being widely used right now, but let's stick with 4. So let's stick with, there are 10 FICO models, 4 Vantage models, but we only use 8 of the 10 FICO and only 4 of the Vantage right now, okay? If you look at a credit monitoring utility that uses a Vantage score, and the same thing can happen, a Vantage 4 score can be different from a Vantage 2 score because of the importance they place on different things. And then, of course, if you cross-pollinate, if you go from Vantage to FICO, then you're going to get a whole different set of scores. So keep in mind, there are different scores for different models of scoring. And each one of those scores is going to send you different alerts based on what they use for the metrics. All right? So keep that in mind. Now, the question is often asked, well, if there are these different scoring models and they're different credit monitoring utilities use them, then what do the creditors use? They use a combination of them all, right? One credit card company might use Vantage 2. One credit card company might use FICO 4. A mortgage lender might use FICO 8. Another mortgage lender might use FICO 2. Just depends on the creditor. How can you know? You can't. You can't. You cannot know. But here's the thing. There's a secret that the industry, the banking industry, is not telling you guys. They are forcing you to concentrate on scores. So they're doing this. Meanwhile, you don't see this hand over here doing what it does. They are not looking specifically at scores, although that's what they're telling you. But they're actually looking at your credit profile and the data points on it. And I'm going to get into those data points shortly. But keep in mind, right now, I just want you to park that, put a pin in it, because I'm going to come back. But what I want you to concentrate on right now is different scoring models are going to give you different scores and different alerts. Don't get manic about those things. Don't stress yourself about those things because they're going to be different. You won't know, you don't know. I'm going to show you how to fix life so that you don't have to worry about them. All right. Also, credit scores are a snapshot in time. What you see today could be different from what you see tomorrow. For example, if on the 1st of the month you pull a credit score or your credit monitoring utility sends you a credit score, it's going to be one thing. On the 10th of the month, that thing could be totally different. And that's because it's based on what was reported. So whatever your credit utilization, let's say your credit utilization on the 1st of August was, and I use this month and we'll talk about the future, right? So let's say your credit score, your credit utilization, on August 1st was 50%. You're going to have certain scores. Then on August 10th, because you paid down your balances, your utilization is 25%. Well, when you look at that credit monitoring utility, it's going to show that your score went up because you paid your credit utilization down. Now, if you're looking at alerts, the minute on August 1st, it sees that the credit monitoring utility sees that you have a 50% utilization, it's going to send you an alert. Your scores have gone down by 13 points. But then when you look on the 10th or that credit monitoring utility sends you an alert, it's going to say that your scores have gone up by a few points because you paid the balances down. Snapshot in time. What you saw on the 1st, different from what you saw on the 10th, and maybe different from what you see on the 15th. By the way, I just want to, let me sit up and say this to you guys. I just want to let you guys know that most of those credit monitoring utilities are using the alerts for marketing. It's not even trying to show you what your scores are. They tell you that, but they're really using it for marketing. And why did I start whispering? I don't know, because I say this proudly. They're using it for marketing. What they're doing is they're showing you, oh, your score went down by 13 points. You better hurry up and apply for a card so that you can decrease your utilization and your score can go up. But guess what happens when you apply for that card? Yes, your utilization goes down. But now you have another card. And what are you going to do with that other card? You're going to spend money on it. The bank is now going to get more money, or the credit card company is going to get more money. That's why they put these monitoring utilities connected to your email, and they send you those alerts. You guys think that they're sending them to you as a courtesy. Do you think the banks do anything as a courtesy to you? Do you think the banks really care about you, the consumer? They say they do, but they do not. They're sending them to you so that you will react and go out and pay for some products that they sell, right? Now, most of you guys are going to say, Kevin, you sound ridiculous, because if my score goes down, how can they use it for marketing? Well, don't you know banks make money off of poor credit? They make more money off of poor credit than they do off of good credit, right? Because poor credit gives you higher interest rates. That's why they can give you a card at 27%. So you got a card right now. I'm not going to endorse any credit card companies because I don't want them to come after me, right? But let's say you get a credit card from credit card company A, and that credit card has a 9% interest rate. It's pretty low for a credit card, right? If they send you an alert that says your score dropped 8 points, and it's true, your score did drop 8 points because they're looking at the credit utilization. But what they will say is your score went down 8 points, but you can get this card and it has a $3,000 limit, then you can, and 0% balance transfer for the first year, and you can decrease your utilization and your score will go up. And they're right. They're 100% correct. What they're not telling you is that second card is a 27% interest rate, and they're expecting that you're going to know that you're going to use that card, which means now they're getting more money. And they got that money because you reacted to the alert. Okay? So don't fall victim to the marketing. Don't fall victim to the alerts. Again, I'm going to show you how to get around all of this in just a little while, but I wanted to make that point. So keep in mind, first things first, there are different scoring models. Each one of the scoring models is going to send you alerts based on their metrics, and it's going to be different. 2, your credit report or your credit scores are a snapshot in time. What you see today may not be what you see tomorrow. Okay? So keep those things in mind. Also, keep in mind, you can't know who's going to use what. You can ask, but you can't know who's going to do what. So just let's work on credit profile. All right? Now, I want to say this one other thing. So I have gotten into a debate, not an argument, because I don't argue. But I've gotten into a debate because when I tell people don't stress yourself about the scores, the pushback is, well, Kevin, I keep getting denied for credit because of my scores. All the banks, the mortgage lenders, and everybody says score, 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 scores. And that's true. There's nothing incorrect about what they're saying. They are 100% correct. That's what they're saying. They're selling you on scores, but they are not absolutely using scores. What they're using is a credit profile. They're saying scores to you so that they can justify charging you more interest. Now, some people are getting denied, and they're saying they get denied based on scores. But I challenge you guys, just like I challenge the people that I've had these conversations with. I challenge you in the audience. Look at any denial. Look at any denial that you've gotten from a creditor. 80% of the time, 8 times out of 10, they didn't put your scores on the denial letter. They put the issues on the denial letter. They may have made mention of scores too low, but they made mention in the context of you got denied because too many delinquencies in a short amount of time, too many inquiries in a short amount of time, collections account or balance due or utilization too high. Rarely do they put on those letters, we denied you because you had a 610 credit score. You know why? Because they're not looking at the scores, they're looking at the issues. Why wouldn't you look at the same thing the creditors are looking at? And they're telling you that they're looking at the issues because they put the issues that they're concerned about right in the denial letter. This is my challenge to you guys. Right now, as I'm talking about this, you can listen. You don't have to look at the screen. Just listen. I challenge you right now. Go find a letter for denial of credit that you've gotten recently and look on it. See if you see a credit score on it. See if you see any one of your credit scores on it. But I challenge you to look at the bullet points or the issues that they said that they used to deny you. They will always tell you that. they rarely ever give you credit scores. Every once in a while, a mortgage company might bring up a credit score. They may show you that your score was this, that, and the third. But even then, right underneath that score, if they show that to you, typically, many times they don't, but sometimes they do. But right underneath that score, they say, we denied you because of this, this, and this. They rarely ever say, we denied you because of credit score. All right? So, if you fix the issues, you can fix the credit scores. Now, fixing issues, the byproduct of fixing issues on your credit is an increased credit score. But don't focus on the score. I keep saying that. It sounds like I've said the word score about 1,000,000 times in this video, but I can't stress the importance enough. Focus on the issues on your credit and your scores will go up. But more importantly, you will give a creditor less reasons to deny you for credit. So let's now talk about the issues. There are 7 components to a credit report. Let's call them data points, or 7 pieces of data that a creditor is going to use to determine whether or not they're going to approve you for credit. Okay? I'm going to put them in order of importance, and then I'm going to talk about how different companies or different types of creditors use them. So first things first, remember that I said there are 7 data points, 7 components that the creditor is looking at. The first and most important, payment history. They want to know how well you pay your bills. They would like you never, ever, ever to have any late or missed payments on your credit report, but that's not realistic. The best thing you can do, though, is not have any late or missed payments within a 24-month period, okay? Now, you guys have gotten denied. It says too many delinquencies in a short period of time. That translates usually to you've had too many late or missed payments. And if you had any late or missed payments, let's say you had late or missed payments in 2022, right? Then you might get a denial, and the denial will say too many delinquencies, your delinquencies are too recent, or some type of variation of that statement. Too many recent delinquencies. They are looking at those late payments in 2022 and saying you've done something wrong in their eyes too recently, so we're denying you credit. Remember, the bank is assessing risk. If you didn't pay a bill in May, right, do you have the money to pay them back in September? It's highly unlikely, or it's not highly unlikely. It's unlikely, and that's what they're looking at, okay? So payment history. Don't have any late or missed payments within the last 24 months. And by the way, how you can really monitor that is if you think you're going to be late on a payment, call the creditor and tell them you're going to be late and say, look, is there any way that I can do something so that you guys don't report me late on my credit report? All right. Next component of data point, credit utilization. Now, the industry says 30%. We want you to be at 25% utilization on each one of your credit cards, not as a whole. Doesn't mean you could be at 100% on one, at 0% on another, and be at 50% when you combine them. No, you want to be at 25% on each one of your credit cards or lower. Ideally, we'd want you to be at no more than 4%, but no less than 2%. And by the way, they're looking at that. Don't pay your balances off. First of all, a lot of people have paid off balances and they've closed the accounts because of lack of usage. Don't have that happen to you. Don't pay your balances off. Keep a balance on there. But 2% to 4%. Let's do 2% to 3.9% if you really want to be specific. 2% to 3.9%, you're going to get the maximum impact on your credit report. They want to see that you can use credit, but they want to see that you can use credit judiciously, or you're able to manage. You like that word, judiciously? That you can manage your credit, okay? So 2 to 4%, let's say 2 to 3.9% of the limit is what you want to have, okay? But no more than 25%. Got it? All right, cool. So now, data point 3, that's your credit age. You want to have at least 7 years worth of credit history. Now keep in mind, if you have 10 years on one card, 0 years on another card, that you're going to average that, you got 5 years. You want to have 7 years or more worth of credit history. And if you don't have it yourself, you can either wait for it or make yourself an authorized user on somebody's credit who's had it for a good amount of time. In another video, I'm going to tell you guys how to do that specifically, but you can become an authorized user. But just know that the data point is 7 years or more. Okay? Data point number 4, inquiries, hard inquiries. You want to have no more than 3 hard inquiries within a 24-month period. Don't go out and apply for credit. 24 months. And in each one of these data points, I'm going to do a separate video that talks about how to manage and manipulate this. So for this video, let me just tell you what the data points are. Okay. So now, no more than 3 in a 24-month period per bureau. Okay. Number 5 is your credit mix. And this is typically where people get hung up. There are 3 categories of credit. There's installment. That means you pay the same amount every month no matter what the interest rate is. There's revolving. That means you pay a different amount based on what you use and what the interest rate is. And then there's open. And that means it's sort of a hybrid. That means you pay the interest rate based on what you use, but you have to pay back the entire amount over a specified period. So an example of installment would be a mortgage, auto loan, student loans. Example of revolving would be a store credit card, a Visa credit card, a fuel card. An example of a open credit card would be a card with no preset limit. And I don't want to tell you the 2 major companies because again, one, I don't want to endorse because they don't pay me. But secondly, I don't want to be liable for any information that they hear in this video. So there are 2 majors. There are several others, but 2 majors with open. But just look for cards with no preset limits. That's an open credit card. All right. You want to have a 2-3-2 relationship in the credit mix category, meaning you want to have 2 installment accounts, 3 revolving accounts, 2 open accounts. And that's where people usually get jammed up. They don't have enough installment, they don't have enough revolving, or they don't have enough open credit. All right. 2-3-2. 2 installment accounts, 3 revolving accounts, 2 open accounts. Do that, credit's good. All right. Number 6, collections. You should have no collections accounts on your credit report. Either settle them, pay them in full, or get them taken off. Whichever you can do, or maybe a combination, get them done. But you should not have any collections on your credit report ever. Last, not least, charge-offs. Same thing. You should not have any charge-offs. Now, charge-offs is what happens right before something goes to collections, if it does. Sometimes companies don't send you to collections. They don't send you to external collections companies. They just keep the debt within their company. So let's say you owe a credit card $1,600. You just didn't pay the bill. They closed the card. Now you have a $1,600 balance. They don't send it to a collections agency. They just keep it in-house. But they charge it off, meaning they write on their taxes really that they don't expect that they're going to get this money from this customer. And so now you're still obligated for it, but they just write to the IRS that they don't expect to get this money. Now in that, same thing with collections, you want to settle those accounts or pay them in full or get them taken off. Either way, get them off your credit report. Now, those are the data points. Guys, if you take care of all 7 of those data points and do exactly what I want, and I'm going to repeat them. Payment history, no late or missed payments within 24 months. Credit utilization, between 2 and 3.9%, no more than 25%. Credit age, 7 years or more. Inquiries, no more than 3 inquiries in a 24-month period per bureau. Number five, I got a thumb here. Number 5, credit mix, installment, revolving, open, 2, 3, 2. 2 installment, 3 revolving, 2 open. 6, there's that other thumb, collections. No collections accounts on your credit report. 7, charge-offs. No charge-offs on your credit report. If you do all of those 7 things, work to fix all 7 of those things, I promise you, you'll have a good credit score, probably great credit score, and you will stop getting denied because you fixed all the issues. And remember, I said this. I know there's going to be some kickback, and I want you guys to comment on this if you guys think I'm wrong. Remember that I said this. The banks use the issues to deny you, not the scores specifically. Although they tell you scores, they're using the issues. So fix the issues, your scores will go up, you won't have to worry about it. Don't worry about those alerts as much as you worry about fixing the issues. Let's get all the issues fixed and you'll be good to go. All right? I've talked a lot. I hope you guys found some value. What I want you guys to do is comment on this video. I want to hear all the comments, whether you're challenged